All right, welcome everybody to our webinar regarding the Majestic in Houston, Texas, the Galleria submarket of Houston, where we own a similar property about a mile away, 101 units. We know this submarket extremely well, and we're super excited about this opportunity. Just to give you a little back history on it, this particular property came my way early in 2023. It's owned by a real estate investment trust out of New York. This is their last property in Houston market. So they're looking to sell this. So this is a direct to seller opportunity, and we're going to go through it very soon. But it came to a point where the basis of what we're buying at and the terms of financing are just too good not to move forward on the purchase of this property. So we're super excited about it. Before we do so, though, let me go ahead and do our disclaimer. So this is not a solicitation to purchase securities. The only document that can actually do that is our private placement memorandum. We'll have that ready for our investors early next week. We want to make sure that everybody that is reviewing this investment is making the calculated risk and the decision and reviewing it to make sure it's a best situation for them from an investment side. Nothing in this presentation is going to contain legal, tax, financial, or any other type of advice. This is just me simply presenting an opportunity for you to review and discuss with your financial, tax, legal, and other professional advisors. This is a 506B offering. So we are taking both accredited and non-accredited investors. This is our first deal in 2023 that we're doing a 506B because we know that there's a lot of our investors that are not accredited. They're looking for investment opportunities. So this will likely be our last investment in 2023. We offered another investment a couple of months ago to our accredited investors for an RV boat storage development. But we're super excited about this one. And again, this will be a 506B offering. So this presentation is going to be about 45 minutes to an hour. I know life is busy. There's a lot going on. So if you if you feel like you want to invest, please do so by, taking your phone, scanning over the QR code, submitting your interest. It's a soft commitment. We're not holding you to it. Obviously, you want time to review, but at least get you on a first come, first serve. This is only $1.5 million raise. So the investment will go very quickly. So I do want to just make sure I put the slide up front that, if you feel like you're ready to invest, go ahead and do that QR code. If the QR code, for whatever reason, isn't working on your phone, or if you prefer to use your browser, go to CREIPartners.invportal.com. And then there you'll be able to register and you'll see the offering listed there. All right, so in every one of my presentations, I always like to go through 3 reasons why I really like this deal. First of all, we're buying at an incredible basis. I did not buy anything up to this point. We haven't bought any multifamily in 2023. And, 2022, we bought 2 assets. This year, we've waited to see how interest rates were going to do, how the market overall is going to do. And it really took this property to really get us over that hump of like, hey, we're ready to buy. And one of the reasons that I just love this deal is we're purchasing $1 million less than the tax appraised value. And these type days, you're seeing a little more of that, not very much, but that's really unheard of in prior years. In fact, you would be buying more than the tax appraised value if you wouldn't even stay competitive in purchasing a multifamily asset, especially in a submarket like the Galleria in Houston. So right off the bat, $1 million less than tax appraised value. That will help us as we go into a future slide about the financials. It'll show, what they were paying in property taxes this year and what we will be paying next year, and see the delta and great savings for us, meaning more cash flow. The other thing I liked about this, and I sort of lumped this, even though there's 2 reasons in one here, but it's less than the seller bought in 2018. Me as a buyer, as an investor, I want a good story. You want a good story. And one of those things is like, hey, we're in a different market in 2023 than we were in prior years. And so if we can buy an asset less than what the seller bought, it's freaking fantastic. And 2018 pricing, we weren't having, the turbulent markets, financing, et cetera, in 2018. So just goes into the fact that, we're buying right. And whenever we're buying an investment, it's always, buying up front is really where you're making your money, right? So $1 million less than tax price value, less than the seller bought in 2018. This is a truly off-market deal. Now, when I say that, we leverage our relationships with our brokers, and we also leverage relationships direct with sellers. And, one of the properties we bought last year, it was direct to seller. This one is as well. I'm communicating with the seller as well, but there is a broker involved. And it's really came to us because of the relationship and us being boots on the ground in the Houston area where we're building and nurturing those relationships. But there isn't a bidding war. In fact, the purchase price when it first came out to us was $700,000 higher than what we actually settled on. So again, off-market deal, direct to seller. So 3 reasons, and exceptional reason number 1 on why I love this deal. Exceptional reason number 2. So 44 units is not a typical property that we would typically purchase. It's typically on the smaller side. For our size company and our investments and our time, we typically do 100 units plus, but about a mile away is the Ivy at the Galleria. And, many of you that are listening or investing in this deal also invested in the Ivy at the Galleria. And it's a win-win at both properties because we can share payroll. The property manager and the maintenance team at Ivy at the Galleria will be allocated to this property as well. So we will see about a 20% savings at the Ivy Galleria on payroll, but more importantly, we're able to drive down expenses, and I'll share that in our pro forma later on in this presentation about how drastic of a change payroll is from the prior owner, who I mentioned was that New York REIT, to us, who's more boots on the ground, have scale in the market, and able to manage this to be very efficient. There will be huge deduction in expenses off payroll, administrative. We'll talk about insurance and taxes, all important aspects of a real estate investment, especially with multifamily. So we'll talk about that on how we're creating deductions and expenses. Exceptional reason number 3, cash flow year 1 and tax depreciation with fixed rate debt. If you're looking for tax depreciation on your other passive income in 2023, this is an asset where we are going to close. There's no risk of us not closing. We've already done due diligence. We've got $1.5 million raised. It's all very doable. So we will be doing cost seg, getting that tax depreciation. So when we give you your K1 early first quarter of 2024, you'll have that tax benefit, but you're also looking at year 1 cash flow. I always typically do the first 6 months, no distributions, just to make sure we're stable. We've got enough cash in the bank as far as reserves, et cetera. And we can sort of get a gauge of, how we're looking, but then starting in 6 months, then we'll start doing our distribution. But this is a cash flowing deal. This is a deal that will cash flow because of the 2 other reasons I mentioned before, with payroll, taxes, buying it right, but also I haven't mentioned, but on the slide is fixed rate debt. So that's another important aspect that I really wanted to make sure in our next multifamily, that we are buying at a fixed rate debt over the term of the hold period. So this is a seller financing deal. So this REIT owned this property right out. And so we're purchasing it. It comes into our name, our entity name, and then we're doing a seller financing. And I'll share more about that loan later. But it is incredible to get a fixed rate deal, especially at the rate that I'll share later in this presentation. So this is not your ordinary multifamily deal. We're not going out and winning the investment opportunity because it went to a bid and we were the highest bid, and we're now bringing you the opportunity. Like, this is relationships and negotiation at its best to give you an incredible opportunity to consider for investment. So multifamily investing, very bullish. There's a lot going on in the marketplace with multifamily investing. We've all read headlines, et cetera, primarily with insurance, taxes, and just, everything that's going on with inflation and possible recessions, et cetera. But I always stay true to multifamily for these 4 reasons. 1, it's risk resilient. It's the basic need of shelter. Now, we are not at CREI Partners focused on Class A premier type properties. We like workforce housing, B and C properties. At the end of the day, those properties, people need a place to live. Even if you are living high life in your Class A high-rise building, you lose your job, et cetera, you're looking at reducing expenses. At the end of the day, the Class B, Class C properties, in my opinion, are extremely resilient in all times of the cycle of real estate. The best risk-adjusted return among other asset classes. I mean, we hear a lot in the news about office, retail, et cetera. Multifamily, when you search across, what other big institutional buyers are buying, multifamily is what they're going into, right? And what they've continued to purchase through the pandemic, and even with everything going on today. Cash flow and equity appreciation is massive. I mean, we get our equity appreciation through forced appreciation, through value add, especially with these properties, older properties. We're able to do that a lot easier than, say, if it's a new property where everything's already brand new and shiny, et cetera. With these properties, we're able to put in some capital and give it a refresh for forced appreciation. But then you're just going to have normal equity appreciation as real estate increases, especially when you buy at a good price at the right time in the cycle of real estate. And I would say in the cycle of real estate, we're sort of on that downward, we're not sellers on any of our properties, but this is the time to buy. When people are running and like, hey, I don't want to buy into real estate because I don't know what's going on. Like, this is the time, in my opinion, to buy, because when people are running, then it gives people like me an opportunity and you an opportunity to buy at a great value. And then when people are running to the asset, when we're looking to sell, because it's the cycle, we'll be really in a great position. So cash flow and equity appreciation is massive in multifamily. And then, of course, you get your tax benefits. We are going to be doing a cost segregation. There is bonus depreciation for 2023, 80%. And then we will continue to provide our K1s to our investors, have that cost segregation tax benefit. Now, I just want to make sure people understand that passive losses on paper offset passive income. So the money that you are making on this investment is, and everybody needs to talk to their tax advisor when they get those K1s, et cetera, but it doesn't offset your active income. So sometimes there's a little confusion on that. So passive losses offset passive income. So huge, but that's how people create their wealth, and their generational wealth is they have that income through multiple properties over time of investing, and then they have those tax losses on paper for tax season. So let me introduce myself, my team, and we'll go from here. Sort of the high level of this presentation will be a little bit about the sponsorship team, and then it'll go into the macro of Houston, then the submarket of Galleria, then this particular property, and the returns and the business plan. So a little bit about myself. I'm Wayne Courreges. We live in the Bryan College Station area. So we're about 2 hours away from Houston. I grew up in the Austin area. I went in the Marine Corps from 2003 to 2007, and I've been in commercial real estate for the past 16 years. In 2019, we started CREI Partners, focusing on multifamily. It scaled into multifamily and build to rent. And then most recently, we've done our RV boat storage, both on the development side and then also owning an RV boat storage in Huntsville, Alabama. So those are the three primary asset classes we're focusing on right now: multifamily, build to rent, and RV boat storage facilities. I've got an MBA from the University of North Carolina. We host a monthly meetup. If you're I always encourage people to get educated, learn as much as they can about investing in, commercial real estate. But on the fourth Monday of every month, we have a virtual meetup. We've got about 1,400 members, been doing it about a little over 2 years. And so been really consistent at it, bringing in high value people to discuss real estate investing. I am a podcast host of the Untold Stories of Real Estate Investing, so check that out. And enough about me. Let me go to my team. So CREI Partners has two incredible assets. Courtney Benduro, who you probably get a lot of emails every other week, and you see postings. She's been doing videos of education, et cetera, on our social media outlets, but she's the director of brand and investor relations. I've known her an incredibly long time. We worked together at our W2 9-10 years ago together. So we've known each other a long time. We built a trust. She's been with us about a couple of years now. And then Whitney Pierce, the director of investor education, she was a huge help in our passive investor coaching program that if you are not familiar with it, we pushed out a program to continue educating and sort of accelerate the learning curve of passive investing. So passiveinvestorcoaching.com, she was a big help with that. We're currently writing a book. We've got ebooks and social media postings, et cetera. She's behind the scenes with that. So, we have a strong team. I'm more hands-on on the asset management piece. I typically do 2 or 3 deals every year. We just happen to have 2 deals in the past 2 months. But usually I'm doing 2 or 3 deals a year because that's what I comfortably can asset manage. I am not an operator who is raising capital into other people's deals and then walking away. Every deal that I am part of, I'm heavily involved with asset management. I mean, that's been my past for the last 16 years. It's what I enjoy. I enjoy the full life cycle. So between myself and the team here, we really try to provide an excellent experience for our investors. So going into Houston, so we own 2 assets with our investors at the Ivy at the Galleria. It's 101 units, about 1.1 miles away from this particular property. And then we have Vanderbilt Lodge, 105 units. That's about 9.6 miles from the Majestic Apartments. So we already have scale. We already have a strong management team that I'll share later. And we're boots on the ground. We understand the Houston market, where it's going, where the rents are growing and where they're not. So we are investing in a team that's heavily invested and really is bullish on Houston. So as I mentioned earlier in the presentation, how this presentation will work, I'm going to talk about macro of Houston, go into the Galleria submarket of Houston, and then we're going to go into the deal. So we're at the Houston market piece. So it is the 4th largest city in the United States. 2.3 million residents live. Typically, I won't even look at a city for an investment unless it has 100,000 people or more. This has 2.3 million, and it's right outside the Belt Loop. There's a photograph and another slide right outside 610 on the west side of Houston. It is the 2nd ranked U.S. Census fastest growing metro. It ranked number 5, population growth 124,000. There's about a 7.1% projected population growth between 2021 and 2026. And the current unemployment rate that I found was 4.5% in June 2023. I found this article through CoStar. We published it on social media about a week or so ago, but it is the 5th top markets for people relocating. So in 2022, Houston was rated as number 12, but in 2023, the ranking, according to POD's 2023 US moving trends, Houston was ranked 5. It's the number 1 city in Texas from this ranking. So CoStar published it, but it came from POD's 2023. You'll see Dallas and San Antonio and Austin on the list, all great cities that I love to invest, et cetera, in. But since we're showcasing Houston, I want to highlight this one because this really just came out last month, or excuse me, in June, that it's the 5th ranked property or city for relocations. All right, so some of the things, there's 2 slides here about city market reviews. First off, it's the number 1 startup capital of Texas, according to Smartest Dollar 2022. It's the number 1 most diverse cities in America, according to Wallet Hub 2021. And number 2 top metros for job growth. The 3 million number of workers in Houston Metro. It's the number 5 cities in the future in North America. Number 2 cities to go and eat, according to Food and Wine, and the best cities for millennials in the Langston Company 2019. I lived in Houston for 5 years. We lived in Cypress, and I absolutely love living in Houston. It's extremely diverse. The food is fantastic. It's hot as hell, but you know what? Downtown Houston, you got the underground tunnels, you got the sky bridges, you got air conditioning. Like, I really enjoyed Houston, not in the summers, but for the most part, the rest of the year was fantastic. But it really is, all jokes aside, like, it's just a very diverse city. A lot of people think of it as like, heavy oil, and it is like, about 50% of the industry is oil, tied to oil. But you also have, the largest medical center in the world. You've got the largest port in the US. You've got an incredible amount of educational institutions that we'll talk about on this slide here. But it's just an incredible city. If you haven't been, some of y'all I noticed on this call, you live there, so you know what I'm talking about. But some of these statistics here on this slide are just quite fascinating. $120.7 billion in top US exporting metro with #1 port in the USA. 33 million passengers handled by Houston airport systems, which there's 2 major airports in Houston. There's 220 trading partner countries. There's 94 international consulates. This is the one I really love too. Home to 23 Fortune 500 companies. Jobs, jobs, jobs. #1 best hospitals in America. I am extremely grateful for the medical system. My daughter had a heart surgery last year, or earlier this year. And when we went to the hospital and the medical center, you know, there were people from all over the country in the waiting room. And I was just like, man, I'm so blessed to be near Houston. And so many people that live in Houston can relate. It's just an incredible Houston, medical facility and center. And people travel all over the world for the hospitals there in Houston. There's 14 major institutions of higher learning: University of Houston, Rice University, many others. But as you see with these 2 slides, there's just a lot going on for the city, and it makes sense why people are moving despite, you know, the Texas heat. All right, so we talked about Houston. Let's go dive into Class B and C multifamily market. So this is citywide, and again, I'm going to go into the Galleria submarket shortly. But in this, there's number of properties: 1,097 Class B, 857 Class C properties. You know, there's a lot of units. I mean, we've got 2.3 million people that live in proper Houston. There's 3 million employees that are living, you know, both in Houston and surrounding communities. But it is a large, you know, city, obviously, with a lot of multifamily units. The thing I like about this slide, though, is that the effective rents over the last 24 months continue to grow. Now, if you Google multifamily in Houston, like I have, you know, and it's good practice to sort of see what's going on. Things are stale right now. Like it is, you know, there's a lot of uncertainty with recessions, et cetera. And that is, you know, it is what it is with that, right? And so we have to underwrite appropriately. We have to make sure we understand our risk and renovations, et cetera, right? That's our job as the active investor. But when you look at the historic trend, the trend is that the effective rents are growing, and occupancy with the growing rents are decreasing a little bit. We're about 91.5, but that's still a very, I would say, comfortable occupancy. Obviously, we all want 100% occupancy, but we typically underwrite 8-10% in vacancy anyway. So if we're pushing rents and our occupancy is still hanging around that 90% plus, we still have an incredible amount of value in the asset that we're holding. So on the next slide here, I mentioned we were going to talk about the Galleria submarket and where it is. So on the right of this photograph, you'll see downtown Houston. If you're not from Houston area, you know, definitely Google Earth or, you know, Google downtown. It's a beautiful skyline. I used to say when I worked downtown, like, these are our mountains. You know, I loved big high-rise buildings, and I always viewed them as our mountains. But the Galleria submarket, I've really honed in on this market because it's right out 610. It is a massive amount of wealth in a little area. You've got Tanglewood. So north of the shaded area here, you've got a lot of high net worth individuals: Tanglewood, West Oaks, Woodway, Memorial Park is nearby. And you've got the Galleria, which is this massive, beautiful mall that has all the high-end shops and, you know, anything you could want and buy, you know, it's in that Galleria area. This property is south of Richmond Avenue and between Richmond and Southwest Park Freeway. So where the Star is. So all in all, in an incredible location, not in a flood zone. I'll show you a flood map. It's another reason why I like this area, because it is not in a flood zone. But it has easy access to 610, I-10, 59, West Park Tollway. Just love the Galleria submarket. So on this slide here, we've got about 84,000 employees, 2,000 companies in the Galleria submarket. I updated the Galleria Uptown submarket metrics here. Occupancy rate's 93.3% in the submarket. There's a population of about 37,000 people. Average household size is 2.4, median income 48,000, and the daily asking rent per square foot in the submarket is about $1.62. But in 84,000 employees, 2,000 companies, it is known as the second downtown of Houston. And the sky high rise with Williams Tower, Marathon Oil Tower, Post Oak, it's just a very vibrant city, a part of the city with it being its own, I would say, downtown district type submarket. So one thing I'm always looking for is, how is our flood mapping? Where are we? The first thing I look at whenever we look at a property in Houston is it in a flood zone? This property is not in a 100 or 500 year flood zone. And so again, you look at the Galleria submarket, just in general, north of this property here, as I mentioned earlier, like this is one of the reasons why I love this submarket. During Hurricane Harvey, we lived in the Cypress area. I managed Marathon Oil Tower, which was in the Galleria submarket, and that whole area did very well. Those that are on the call with Houston, there's different flooding events throughout Houston. It is very flat and there's a lot of concrete, but the Galleria submarket has held up extremely well over the years. This property has not had any loss history, at least in the 5 years that we've seen with the current owner, and didn't show any signs that it had experienced any heavy damage in any other storms previous. So from a risk standpoint, I'm investing along with those on this call and those listening in, that we want to make sure we reduce risk wherever possible. So this location here is not in a flood zone, which is huge. So the next few slides, let's talk about the property here. So the current owner I mentioned is the New York REIT. They have outsourced their management to Tarantino, which is the same management company that we use at the Ivy at the Galleria. And over the last year, so they switched to Tarantino about a year ago. And when I look at their T12, which is the last 12 months of income and expense loss, the income continues to move forward. And I'm going to show you a T3, which is the last 3 months of financials. It continues to go up, and collections has been really solid. So this owner has managed it extremely well. This is a 1964 property, and a little older, but it doesn't have the characteristics of a 1964 property. For example, there's no cast iron piping. Everything is PVC pipe. They're all individual HVAC units on the roof, which we've had inspected. 14 years old, so we have contingency for replacements, but overall good working order. No issues found from our HVAC company. He was overall very, very good on the HVAC. We had plumbing cameras go through all the plumbing lines. No issues there. Again, PVC. Typically, these older properties, you'll have cast iron piping, which has a lot of corrosion and issues over time. So you just budget for that. But in this property, it didn't. This property also does not have any aluminum wiring for electrical. Typically, we would pass on a property that had aluminum wiring. And the reason is because it drives insurance rates sky high. This is all copper wiring. So from a risk standpoint of fires and insurance premiums skyrocketing, so all those check boxes, there's no stab lock or Federal Pacific breakers, those things that I look for that I just don't really want to touch. This property didn't have any of that. We had a roof inspection. The roofs were in good condition. We've got contingency for, the one-off roof leaks here and there, but the coating looked very, I want to say new, but very well maintained as well. So there's not a lot of CapEx on the exterior. When we bought the Ivy at the Galleria, that property had a lot. I mean, it was a crazy amount of work. We had to do all the roofs. We had to do all the HVACs. I mean, it was just a major renovation project because the prior owner didn't take care of it. With this one, I'm not really having to do a lot on the infrastructure at all. I mean, there are some things we're going to be doing, and I'll share that shortly, but really it's giving it some lipstick, keeping it fresh, making it more feeling like home for our community, and not having to spend too much money on infrastructure that doesn't really add value. It's just sort of a necessity. People expect to have HVAC in Houston. People expect to not have roof leaks, et cetera. So it's another reason why I really love this property is there's not a lot of that. So Tarantino is, as I mentioned, the manager of this property. Ivy at the Galleria, we have Tarantino. So we're going to have a shared management from our office at the Ivy at the Galleria to manage this asset. So they're actually based in the Galleria. They've got track record. We've had great experience with them turning around that property that we own there. And so we're excited to continue the relationship with them. But the value proposition here is we're going to increase market levels over 2 years. I'm not going to go in as an owner in this market and just like day one, everyone's paying $100 more. No, it's building relationships, updating the community amenities, freshening the property, and then over a 2, maybe even a 3-year period, we're pushing rents, conservatively, so that way we can retain our tenants who all are paying on time. We have no evictions at the property. I got the age delinquency report today, and there's 2,000 in delinquency, which is nothing on this type property, and they're all scheduled to pay. Last month they had 100% pay. So it's just, those are the type of tenants and residents we want to keep. So we're going to move this property into higher income, but we're going to reduce expenses through maximizing the efficiencies through a nearby property. So the site amenities on this property, 24-hour access, there's a courtyard, outdoor grills, there's a laundry facility. Right across the street is this massive park that has a baseball field, there's a basketball court, there's tennis courts, there's a playground. When I first went to this property, I was like, oh, one of the things I love doing was adding playgrounds to the property. And someone reminded me there's a huge playground right across the street. I'm like, that is incredible. Like, we don't have to do that. It's right there, but yeah, we can show our future residents that we have, those amenities just being so close to that park. And then there's sidewalks. If you drive by there, you're going to see some construction going on right now. And what they're doing in that whole area, I would say half mile around this property, are redoing the roads and adding sidewalks. So make it a lot more, friendly for those that are walking around. And so that project should be done in October. So if you drive by this property, you'll see that. But I think that's a huge amenity, having that access of sidewalks around to nearby restaurants, getting to the park, et cetera. So great to see the city starting to, or continuing to invest in this submarket. All right, so on this slide here, wanted to go through what I saw when I did the interior walks. I walked every single unit here. There are 2 studio apartments. There are 31 bedroom apartments and 12 2-bedroom apartments. So there are 4 buildings. 3 buildings have all 1 bedrooms, and there's 1 building that have the 2-bedroom units. It's a 2-style garden style. So there's 2 floors. The average rental rates of this property is $750 to $825, extremely well below market. I'll show you comps shortly. And we already talked about the amenities, but these are the 2 floor plans that, other than the studio, I put the 2 floor plans. The one on the left is the 1-by-1 bedroom, and then the one in the middle is the 2-bedroom. The thing I love about this property too, and what I found out, it used to actually be a motel, is the property, all the units are in pretty good shape. I'm not having to go in and replace appliances. Notice this picture has, on the bottom right, has this black stove and the black refrigerator. Every unit already had that. Every unit had the granite countertops and already had the beautiful wood cabinetry. I'm not really doing much on the cabinets, or excuse me, the kitchen. The bathroom on the left here there, already nicely tiled, has the granite, nice toilet, nice tub. Like, some tubs will have to resurface and there's contingency, but for the most part, all the units were in this condition. Really, when we buy value add properties, we're like, man, we're going to have to go in and spend $8,000 to $10,000 a unit. Not here. The strategy here is we're going to replace the flooring as needed and update paint and resurface as needed. Like, it's not, we're not going in and doing major renovations, because these units, one, don't support the high rents that would potentially come with a major renovation, and two, it just doesn't need it. It may need 4,500 to 5,000, maybe a unit on the heavy side. But in overall condition, I was extremely impressed with every unit that I walked in. So that's exciting because, a lot of times, appliances alone, could cost you $2,800 for the package. So we talked about the maintenance here. One of the reasons why, I'm always trying to convince myself, like, is this a good investment? Because there's always a risk, right? I mean, when we buy a property, there may be like something comes out that we weren't aware of, but we try to do our due diligence as much as possible. We talked about how there was copper wiring, copper wiring, no aluminum, no stab block Federal Pacific breakers, PVC plumbing, so that no cast iron. We did all of our inspections. So we don't have to do a whole lot on the infrastructure, as I mentioned before. So what is our renovation plan? One, you're looking at a picture of the front of the building. And, on other slides, I think in the first one, you just saw the stone. It just discolored. It just looks aged, right? And very bland. It blends in with all the other properties that are sort of in this area, right? Which are mostly, car industrial type properties. And so first thing we're going to do is exterior wash all the, pressure wash the entire exterior. It's pretty low cost and, lets us see what we're working with. This front here, I want to do paint just on the front, change the shutter colors there, and then add planter boxes. So if you can imagine with me, you have these windows, but underneath do some planter boxes with some faux greenery. So really just give this front entry a pop that it needs. We're going to go in and on the interior, like when you walk through these doors to this photo here, you enter the courtyard and there are windows that are facing this courtyard on each of the units that have wood rot from condensation. So we're going to go ahead and do repairs to those exterior windows to maintain the asset. And we're going to paint the railings and give the courtyard a fresh, fresh look. We don't need to paint all four walls and everything like that. That does not make sense because the property overall, it looks nice without it, but just having this front painted, update the life of the front, and then going in and having the railings be the accent will be huge. The other thing I want to do as part of this renovation is I want to make the courtyard more community home feeling, where people will want to go outside and just enjoy living at the Majestic. So the gazebo grill area is what we did at the Ivy at the Galleria. It's beautiful. I've got a picture of it in a later slide, but it has been incredible. It's a Costco gazebo, a grill outside, like it's pretty low cost, but it adds an amazing amount of returns because our retention of our residents and then showing people our prospects of, that amenity alone is quite huge. The other thing is because of the location of this property, we want to look at encouraging bike riding. So we'll have, bike rack. The landscaping needs a refresh inside, but I want to do things pretty, I'm happy to spend money up front, but I want to make sure we don't then have to spend a lot of money on maintaining the landscaping as an example. So what we're going to do is do turf and planter boxes where there's already bushes, add some rose bushes as well, and just really give it some more life where we don't always have to go in and put mulch or replace or have an irrigation system, et cetera. So the landscaping is going to be done right the first time and in a way where we can do it once and not have to keep coming back and maintaining. I had mentioned that the HVAC units were 14 years old. So we have contingency to replace those units as they come. I've debated back and forth, like, hey, do we just replace them all? And we have capital to do that. But if they're working order and we're able to repair, then great. But if we start seeing like we have a lot of maintenance costs because of the HVAC units, or it's hard to get the refrigerant, or it's too expensive to get the refrigerant, we do have the contingency for that, but I want to be mindful of our capital spend, and spend as it happens, or like, hey, does it make sense? Because we're saving on maintenance operating costs, right? So it's just more of a holistic idea of what we're doing. And I apologize, but one of the last bullet points is, you can't really read it. So that's my fault as I did the slide deck, but the renovation of 44 units. So I had that over 3 years. So it's going to be, over time, people are going to leave. And hopefully, it's, over time where we do it, but we'll renovate and then we'll refresh. So on a future profit and loss income statement that I'll show you in a future slide, you won't see turnover costs, right? Typically we'll have like turnover costs because we're going to be renovating all the units that become available to us. We'll go ahead and do the flooring, new paint, really just give it some refresh. And by doing those major 2 things, and then, if there's sheetrock repairs, et cetera, we'll obviously have to do that, but we'll be spending it through capital. So I mentioned Tarantino. The group that is managing the asset is incredibly important. I'm a big believer on third-party management, only when you find the right manager, right? Because third party, you don't have as much control with their operating procedures, et cetera. So there's a lot of active sponsors that manage in-house, and there's nothing wrong to that. There's benefits of that and there's cons of that. I have chosen to partner with a strong property management company. One, they have the resources. So if there's ever an emergency or after hours or somebody's sick, there's always somebody that can respond to the property. If there's a vacation, et cetera, you've got a management company that's large enough that can support. I also like that they're local. They're based in the Galleria submarket, which I really like. And again, they already have one of my other properties, so it's an easy transition. But, this company, Tarantino, is recognized by the Institute of Real Estate Management as an accredited management organization, AMO, and they meet all the criteria from accounting and just property management. So great company from our property management side. So let's get down to the deal breakdown, sources of funds, uses of funds. So the total loan, let me back up. The total purchase price is $3,327. So $3,327. That's comes out to about $75,000 a door. And if anyone, for those that have, looked at other deals in the Galleria, typically you would see in today's market, maybe 90 to 100,000, maybe like high 80s to 22, 23 pricing where there were 115, 120, 130, 40,000 more, just depending on the asset class and where all in this area. We're buying less than the 2018 sales price and $1 million less than tax value. So 75,000 a door, if that doesn't get you excited, just hearing that, that is an incredible number in the Galleria submarket. We're doing an 80% loan to value alone. So the total loan is $2,661,600. Our investor equity is about 1.5. It is 1.5 million. And this is how it's broken down. So the site acquisition is $3,327,000. We've got our capital expenditures of $453,600. In that number, I've got about $200,000 that's contingency for these HVAC replacements and anything that may come up. We will spend about $288,000 in the first 3 years. That was an agreement I had with the seller, is that we would spend that much. So the remaining is just like contingency, as things come up, we'll do. But a lot of that 280,000 is unit renovations, and also the projects we were talking about, we're refreshing this corridor that you see in the front exterior. You'll have the acquisition fee, loan fees, and the KP fee. So this is the title, closing, transaction, our attorneys, and then our KP fee for signing on the loan and taking that risk. And then we'll have contingency reserves of $205,000. This reserves is our rainy day fund. If we have a major repair or something's happening, we've got money in the bank that's setting us in a very strong financial position. A lot of properties that have been struggling that you've been hearing about, they just didn't have enough reserves. And, I am always of the mind, have the reserves. That reserves are distributed back to our investors, at sale, but it's better to have that in the bank to make sure we're, well capitalized, with anything may happen. So mention a little bit about the loan breakdown, but this is a slide of itself, because in this market with interest rates, you as an investor and me as an investor need to know what's my risk on the loan? What's the risk on the interest rate? So the total purchase price, I mentioned 3.3 million, price per door is 75,000, but the 5-year fixed rate seller financing 6%. There is no Fannie Freddie loans right now that are getting you the 6%. The prime rate today, I think, is like 8.5%. You know, it's an incredibly great rate. And what I see a lot of times with these seller financing is they'll do like fixed portion, 6% or 5%, maybe year 1, 2, but they don't do it for the full 5 years. And they definitely don't do interest only for the full 5 years. So this is a 6% seller financing that I negotiated for 5 years, 80% loan to value, interest only for 5 years. So the total loan amount is 2.6 million. So part of the negotiation of purchase price and then the financing of the debt were 2 major milestones. So like it took a while. I mentioned it, I learned about this opportunity earlier in 2023, and here we are now. But big part of that was interest or loan, and then the purchase price. Both we were able to overcome, which made me super excited to bring this to everybody here. So we have the 5 years fixed, and that's our hold period. It's 5 years. Now we will look to sell about year 4, and so we'll have plenty of time to sell the property before the loan becomes due. But that will be definitely on the on the radar as we get closer to that 5 years. All right, so let's talk about rent comps. So all these properties are within a half mile to a mile and a half. The nearest property to the Majestic is Tanglewood Place, and that's a half mile. If you've been in the Galleria submarket, there's a lot of properties, Ivy at the Galleria being one, that have a lot of other apartments nearby. This one sort of stands out on its own. Next to it, it's a car shop. There's a lot of industrial. Across the street is the park. And so from a competition standpoint, if you want to be in this area, say you work by or, near this area, like the proximity to the highway, et cetera, it's a solid choice to live at, right? Because the next area is a half mile, which is Tanglewood Place Apartments. The other thing I like about the Majestic that I want to highlight here is the size of the units. So the 1 bedrooms are 660 square feet. So generous size. The 2-bedroom, 1 bath is 864 square feet. The effective rent $795, 2 bedrooms, $975. That's the current rental rates that's being published right now. So that comes up for the Majestic about $1.20 a square foot for the 1 bedrooms, $1.13 for the 2 bedrooms, and the average about $1.17. So keep the $1.20 and the $1.13 in your mind as we go through the next few slides, because all the other properties are going to have different size square footage and they're all going to have different effective rates. But what we look at is the per square foot. How can we push rents comfortably with the competing properties in the area? So on the next one, Tanglewood Place, notice the rent square foot for the 1 bedrooms is $1.46, 2 bedrooms $1.23. So just the half mile away. It was built in 1974, larger property with 86 units, but we're total average $1.34 a square foot. So I like that there. Montebello Gardens is another great comp for here. It's about 0.9 miles, 1973 build, 109 units. The 1 bedroom is $1.64 a square foot, 2 bedrooms $1.45, total average $1.55. We look at the Chateau d'Agen, we've got that's 0.7 miles. Again, just looking at the rent per square foot, $1.64, 2 bedroom $1.40, total average $1.52. So going back to original slide of the Majestic, $1.20, $1.13, already 3 properties shows very good upside. Now, I don't think I'm going to get to $1.64, because if I did that, I'd have to probably lose every tenant at that property. I'm not wanting to do that in this climate, right? But we can push it over time and comfortably get our rents to a point where, we are, instead of $1.64, let's get to $1.40. I mean, shoot, we're at $1.20, let's move it up closer, right? And by doing those amenities and again, having the relationship with our residents. So on this next slide, Ivy at the Galleria, this is the property we bought last year. This photo would look drastically different than a year ago. We have done an incredible job on this renovation of this property. But the one bedrooms here are $1.54 currently, 2 bedrooms $1.42, total average $1.48. And then you have a Ridley 1.1 mile, 1969, $1.56 for 1 bedroom, $1.20. Every property on this comp sheet within the 1.1 mile or less is much higher than our rents here. So we have room to grow. We're not already at the peak, and there's definitely room to grow. So, and then the last property here is Yorktown Apartments, $1.55, $1.26, $1.40 is the total average. So comparing all the comps, if you look at our average size of the unit, 762 square feet. If you average the size of the 1 bed, 2 bath, and then the comps average size is the 791. So we're slightly less than our comps, but our effective rent, let me scroll over to the rent per square foot. You'll see $1.16 a square foot average. The comps are averaging $1.43. So great upside, done right. So we're not losing our residents. So we're not having, massive turnover. We'll have incredible revenue growth, right? And then we're going to talk about the expense, because expense deductions are just as important as the revenue growth. I'd rather be conservative on revenue and then drive the expenses down to maximize occupancy, which maximizes cash flow. So let's talk about that here. So T12s is the last 12 months of the financial period. So if we're looking at the T12 currently, since July just closed, you would look at August 1st, 2022 through July 31st, 2023. If you were looking at a T3, it would be the last 3 months of when you're looking at it. So on the T12, you'll see the actuals, the seller financials, and then you'll have year 1 through year 5 projected revenues. So we're staying conservative on our rent growth. Year 1, 2%, year 2 through 5, 3%. The days of the 15 or 8 to 15 plus percent, that's behind us as far as we see for now. But we see conservative rent growth, especially when we're doing upgrades and providing, a great place to live. You'll see the growth. Annual other income, we've got 1%, and then annual operating expense growth 2%. We do think the inflation is going to get back to that 2% or close to it with all the Fed hikes. So we're keeping that there at the 2%. So on the rental income, I wanted to really scroll down to effective gross income. So we've got $414,701 for the T12. That's the last 12 months. Their income was $414,000. On the year 1 projection for our underwriting, we're at $432,000. So on future years, we're at $474,514. So there are jumps in years. And so part of the strategy that we're doing is, one, showed you the per square foot rent for the comparables, but we're also implementing a reimbursed utility billing at the property. So right now they pay a fixed rate for water, and then they pay their own separate electricity. We're going to be moving that into year 1 to year 2 to fully RUBS system. I was conservative on year 1, even though new leases and new renewals will be immediately implementing it. But just to try to stay as conservative as I could, year 1, I put 0 for RUBS. Year 2 will be fully into that program. The vacancy loss kept that 8% through the whole period. We've got loss to gain to lease. So, that will trail off as we lease and renew the units to closer to market. So that will reduce away. And then the credit loss bad debt, you never know what the bad debt's going to be of a property until you buy it. And so we typically do 1% year 2 to 5, just given what's going on in Houston and the delays, the eviction processes have been going. I just bumped that up, a little bit, kept it at 2%. So doubled what I normally would do. And then for year 1, did 2.5%. Now, last year they had 100% last month they had 100% collections. This month, all but 2,000 has been collected. So if they build about 36,000, they've already collected 34,000 in the first 10 days of the month, which is outstanding. So I don't think we're going to be using this bad debt as much, but definitely want to stay conservative. So if we can take a note of the 432,000 for year one, that's going to help you on this slide here. So whenever I look at, because I mentioned Tarantino started managing the asset about a year ago. So I'm always looking at like, okay, what's the trend? What's the last 3 months trend? Again, I'm always trying to convince myself, like, does this investment even worth our time? So on the total revenue for April, 34,641, in May, 35,711, and in June, 36,608. So it's already showing that there's improvements in monthly income. Checkbox, checkbox, checkbox. Great. But if I annualize this, if I average the three numbers here, 34,000, 35,000, 36,000, I take the average of those three numbers and I multiply them by 4 to get 4 quarters worth of revenue, or a year's worth. I'm at 427,836. If I do absolutely nothing, I'm $5,000 away from hitting my year one target of 432. So, again, when we're trying to convince ourselves, like, hey, is this a good investment? Is this something that, makes sense? Because, there's a lot of risk in real estate, right? Everything going on. If I do absolutely nothing, I'm $5,000 away from my year one revenues, right? So 427,000 is the annualized growth on the past 3 months. Okay. So I'm really bullish just on that alone that we can hit our year one. Now our year two bumps up largely because of our loss gain to lease. So we're renting the apartments closer to market that we're pushing. So this is going to start trailing off. Our vacancy loss stays the same, 8%, staying conservative there. Rent concessions stay the same. We're reducing. Hopefully we've brought in, if there are any bad apples out there in our apartment building, we've changed those out to people that have, better paying, traction, et cetera, in their rental history. So we've got that going off. But going back to the RUBS, this RUBS utilities, 14,000, that will be implemented year two. And that's something that's market wide. We did at the Ivy, at the Galleria, all those properties that I shared, it's all market. So when you are boots on the ground and you know the market well, you know that we can implement these things without much resistance from our residents because the market's doing it. On other income, we kept it flat. I do think we can push other income, maybe doing some parking and such, but I don't want to just flush the revenue so much that we start losing people, right? So 432,000, pretty close to where I already am now if we just maintained the revenues. The other thing is great about this property is the manager that's managing this currently is staying involved. So we're not going to have a change in managers, have to change, build relationships with the existing residents and all. That transition, it doesn't exist. A lot of times we buy a property and we want the property management because we love the horrible reviews that are on Google. We're like, okay, great. That's an opportunity. That's a value add. Manage the asset better. In this case, if you go to Google on this property, they already have 4.4 stars. I'm not rebranding the property. We don't need to, right? And we're using the same team that's already there in place. So I feel very good that we can hit our year one and then year 5. All right, so we're going into the numbers here. And I know it can probably cause a little headache, especially later in the evening. But let's go through this. Property management fee, it's a fixed 5% fee to Tarantino. That's their cost for covering their accounting and their overhead and their profit. So that's 5%. Very confident about that number throughout years 1 through 5. Notice the numbers do increase years 1 through 5 because revenues will increase years 1 through 5. General administrative fees, we've got that about $150 a unit. So because we are managing from a different office and we can split cost, you'll see on the T12 for the actuals, 12,305, we should be able to cut that in half just by sharing space and expenses with the nearby property. This expense also reduces that expenses of property. So it's a win-win for both places. Contract services, they didn't have any money supposedly spent for contract services, but pest control, trash, landscaping is not really needed. We'll have our maintenance person just trim up the bushes that are there as needed, but there's not a crazy amount of landscaping. There is a lady that's on site that does have a rent reduction. And what she does is like helps with trash pickup around the property. I met her. She's an amazing lady. And we want to continue that with her, having somebody who's sort of the eyes of the property since there's not an on-site office. But anyway, that contract service is mostly pest, trash of the asset. We've got marketing. I kept that pretty similar to marketing that's been currently spent. They've got apartments.com, they do flyering, et cetera. But payroll, look at the dramatic decrease from what current ownership is paying versus what we are paying. This is where we really push our cash flow and our cash flow distributions. So 65,000 was the T12. So if you are buying a 44 unit, which is why a lot of times I don't like these smaller properties, the payroll per door is just drastic. And if you don't have nearby properties, it's hard to split those expenses, right? But on this property, we're taking 20% of the payroll allocation from our nearby property to reduce that expense there, but also reduce expense here by over $40,000. So this payroll number looks fantastic, and it's done in purpose because of our efficiency of scale owning properties nearby. Okay. Repairs unit and maintenance, we've got $400 per unit, which is about $17,600. If we start seeing a lot of HVAC repairs needed, we've got contingency where we're going to replace those. We're not going to spend a lot of money on HVAC from R&M, but you'll see that their expense is like $57,000. They spent a lot of money on their facade doing some repairs over the last year. So a big portion of that is just one-time expense. But typically what we see for repairs and maintenance is about $400 a unit. Turnover costs, you don't save any money until year 4 or 5, and that's because we're going to renovate units between years 1 through 3. And then other miscellaneous is sort of a catch-all that I like to have also covers our tax filing fees, get your K1s, but also just a catch-all. So we're reducing our controllable expenses by half than what the T12 shows. And we're doing that primarily because of payroll and savings that we'll have by owning an asset nearby. So controllable expenses, we're doing our best. I mean, we're going to increase revenues conservatively and systematically in a way where we don't lose people, but really find value in reducing controllable expenses where we can. Then you get into non-controllable expenses. So insurance. $726 a unit is what we were quoted through our insurance provider. I bound that insurance as soon as we received it, meaning we already have this insurance. I'm not having to go out and file. It's part of my due diligence. You're seeing insurance in the market to be $1,500 to $2,000 a unit. For us to get insurance that have full replacement costs, terrorism, assault and battery, general liability, et cetera, at $726 a unit, it's an absolute steal. We were able to get a solid proposal, one, because of the condition of the property. We had to show all the inspection reports and show that this has good bones, and two, show that there's no loss history, but three, also with the relationship we have with this particular broker. Real estate taxes, year one. So let me back up. So T12 is $84,673. That's what they paid January of 2023. This year, taxes on all these properties in Houston have just skyrocketed. And, we're going to litigation on our properties that we own, try to reduce those values. But year one, notice it's $90,000. Well, the $90,000 numbers on the 4.3 million appraised value. Remember, I mentioned where we negotiated a sale price 1 million less than what it is today, right? Appraised value. But year one, I'm projecting $90,000 because it's going to take time for the city to realize what a great price we bought this property for. Now in year two, it drops, which normally real estate taxes don't drop. But the 70,350 is 100% value of what we purchased. So when we go to protest our taxes, I probably will just do it myself and not pay a consultant. It's just going and showing the price that we purchased it at. And then I'm assuming we're going to pay 100% of value on that. So that's what that represents year 2. And then year 3 to 5, we'll have our increases, but we'll protest every year as other properties in Houston does. So you'll see a drastic drop in real estate taxes. This is not really a risk. This is like, it is what it is, so our insurance is what it is. I already bound it. I already have it. Happy to share info on that because it sounds really too good to be true. We're super excited about that. And then real estate taxes, it is what it is because we'll have a PSA, purchase sale agreement, that we can show the Harris County Appraisal District, and then we'll lock in our new value, which our rate will come down. And then utilities really just kept this moving upwards. The cost of water in the city of Houston is going up. And so we do expect there'll be, those increases there. So didn't really reduce utilities much. But as we scroll down, we'll look at net operating income. So our net operating income for year 1 is 207,000, year 2, 262,000, and, pushes up each year after. We'll have our asset management fee for CREI Partners to manage this, manage the management company, in-state, heavily involved with the operation of the property. And then we'll have the debt service. So notice the debt service is fixed for the 5 years, and it's only interest only. So the net cash flow before tax is 35,000 year 1, 88,000 year 2, 117,000 goes and moves upwards from there. That is where our cash flow to distributions go to our investors. So the net cash flow after all the revenue minus expenses and the mortgage, this is what allows us to pay our investors. I mentioned earlier in the presentation, I usually start cash distributions month 6. So this will be cash distribution 35,000 year 1, 88,000 year 2, and then your pro rata of that investment will be split between this growth of returns. The other thing that's huge here is we want to find investments year 1 that exceeds the debt service coverage ratio that we typically want in real estate, which is 1.25. So if you think about it, if you have a 1.0 DSCR, you have enough income to pay the exact dollar amount of your mortgage and nothing else. $1.25 shows that you can pay your mortgage, and you've got, for every dollar, you've got another 25 cents to pay your expenses. And then, in this case, we've got $1, 1.3. It's not $1, it's a multiplier, sorry, 1.3x. So this, because of the cash flow revenues that we're projecting, remember we're 5,000 off from T3 projections, our controllable expenses, which I just went through, and our non-controllable, we're at a 1.3 on year 1, year 2 is 1.64. When things tighten, or if we have things that happen at the property, having a high DSCR reduces the risk for everybody on this call and those listening in. So super excited about those cash flow and expense numbers there. So let's talk about the deal structure. One of the things that I like to do is I like for all our investors to feel comfortable with the returns. And I've gone away from saying, we're going to have a 2x multiple or 1.9. A lot of people are doing that. I rather give you like worst case to like best case. And I always like to be in the middle, but at least you sort of know where you stand and if it's something that you're comfortable with, right? And so on this deal structure, we're doing a 75%, 25% LP GP split. So our limited partners will own 75% of the asset. The GP will own 25%. We'll have an 8% preferred return. Typically I do 7%, but because of our cash flow projections and how I'm seeing the asset, I'm doing an 8% preferred return. After 18% IR, we're going to split the profits between the limited partner and the general partner 50-50. So where I see this happening is closer to, on the investor IRR is 15%, equity multiple 1.9. I mentioned the preferred return. Those are the numbers that I'm sleeping pretty good at night. But what happens with cap rate? So I'm assuming cap rate on this deal will be a 6. I think interest rates are going to go down. I'm following the forward curves. And, give you an example. Last year, cap rates were high 4s, low 5s, right? So I'm still feeling comfortable around the 6. But what if it's at 6.5% cap? Well, that's where I'm getting on the equity multiple of 1.7 and the investor are 12%. It's still really good returns. 14% average annual revenues beats the stock market and other places, plus you're getting the tax benefits, et cetera. But I want to make sure that we're being conservative. So I'm saying 1.7x multiple to 1.9. I'm sleeping well at the 1.9. The 1.7 allows you to sleep at night when you're making a decision to invest as well. So obviously nobody has a crystal ball of where we're going, but given the risk and the things that we've already removed from the investment, I feel very good about these numbers, especially in this environment. So for a $100,000 investor, year one, and again, it's about 6 months in, we'll start paying out our first distributions. Year two, we'll have about 5.89% paid out to our investors. Year three, 7.86, and it goes from there. Now, I mentioned 8% preferred return. So how do we get that to you? Well, it accumulates. So I'm being conservative here on my cash flows. So if our cash flows are higher than projected, then these returns will increase. But it's preferred return, so it accumulates. So if year one, since we're going to be short 8%, it accumulates to year two, and year three, year four. And then notice the year 4 and 5, we start getting that 9.2, 9.86. You're making up for that return from the other years that you didn't get that 8% preferred return. It's in my benefit that you get your returns first, and then we get our returns second. Because my goal is to make you as much money first, me second, so that the hope is you reinvest. And I think it aligns the investors where it needs to be, because a heavy amount of the cash flow is for them. So on this 14.78% IRR and 1.91 equity multiple, given this example. So let's do a sensitivity analysis. What happens if cap rates decrease? If we're at 5.75% exit cap, we're looking at a 2x multiple, 16.2% IRR, 5.5, if interest rates go down and then you've got stability in the market and you have people that have been sitting with cash investments, not deploying this year and the next, you're going to have a high demand. So, we could see cap rates go back down, but if they don't, say it goes up to 6%, that's our base model, 14.8, 1.9x multiple, still very solid, very good investment. In today's standards, 6.25, 13.4 at a 1.8x multiple, 6.5% exit cap. So if you've done any of my meetups and you know my presentation, we always remember that exit cap rate can really shift to make numbers look really good or really bad, right? But if you're making a 12% IRR, 1.7x on that's an average of 14% a year, which is very solid. So I don't want to overpromise and underdeliver. I'm going to, go right in the middle of the road, average, round up to 15%, 1.9x, and then show you on this slide, what are all the other considerable factors that could happen if interest rates, cap rates go down, or cap rates, interest rates continue going up. The great thing about the interest rates, if they do go up, we're still cash flowing. Right. So we're not losing our cash flow because of higher interest payments. All right. So let's talk about the investment timeline. We only have 2 more slides here. Really appreciate everybody staying on with me and following through. So the July 18th, we went under contract. I spent every moment of that 15 days or so for due diligence and unit walkthrough. We went through a lot. Also wanted to make sure we had our insurance taken care of. We've got our webinar today. I think today is actually the 10th, so I apologize for that. But investor webinar August 10th. We'll have our PPM availability, our private placement memorandum done early next week. I'm planning on the 14th. And then we'll have investor funding from August 15th through September 1st. and then our plan to close on the 15th of September. So again, the raise itself is $1.5 million. We've already done our inspections and everything. So we'll finish this raise. I am waiting on the entity. I submitted that to the state 2 weeks ago, and just pending the approval for that entity. That way I can start open a bank account, and that's where the investor funding August 15th to September 1st. We do anticipate this to be a 4 to 5 year hold. So 2027 to 2028. I always tell investors though, if year 3, the market's popping, everything's looking great, and we can get our investors their returns to 1.92x multiple, that is something we will be very interested in doing. But let's be conservative for the full 5 years, and make sure we're all communicating that this deal could go into 2028. This is a 506B offering. So we have a pre-existing relationship with myself or anybody on our team at CREI Partners, we can have you invest in this deal. And then any accredited investors. So for those that are not sure if they're accredited or not, the SEC defines the accredited status, $200,000 per year if you're an individual, or $300,000 in income if you're married, or have a net worth of $1 million, not including your residence. So that could be all your personal, belongings, if you have another property, your auto, et cetera, your stocks, all those other things outside of your home residence. We will need to, if you say you're accredited, we'll have to get it certified by a CPA or through this verifyinvestor.com. It's pretty straightforward to do. But if you're not an accredited investor, and you've been wanting to look at investing in real estate on a syndication, and you've been educated and you're ready to make that investment for yourself, this is the deal. If we've had the relationship, this is the opportunity. I will promise you, we will not do another 506B in 2023, and 2024 we may look at doing one if we find a good deal. But typically we do 506C offerings, and the reason for that is because it allows us to advertise through social media and other avenues to raise our capital. So as I mentioned, we're a 506B. So the next steps, go ahead and use the QR code there, or go to the website CREIPartners.invportal.com. You'll find the Majestic Apartments offering there. You go ahead and click reserve now. It's a soft commitment. You reserve now. You put in your investment. The minimum investment on this deal is $50,000. It's pretty standard across the syndications. We just prefer not to have 200 investors raise with the 1.5 million, but it also allows us to be more selective too. So we want to make sure it's a good fit for you and us, as we're partners. In essence, both you and I are owners in this deal, and so we want to make sure we've got the relationship and that it's a good fit, that it makes sense, for you as an investor. So go ahead and use that QR code, and or go to CREIPartners.invportal.com and reserve now. We've already had people prior to this call reserve their amounts, so I'm very grateful for those. We have a lot of repeat investors. I feel very blessed and fortunate with that, and I thank y'all for the trust and the continued partnership. I do not the fiduciary that I have to do as much as I can to grow your wealth. It's something that's heavy to me. So I really appreciate that trust and that continued partnership. So thank y'all so much. I am going to do some Q&As, and so if you have questions, go ahead and put them in the Q&A box, and we'll go from here. So, all right. So is the current Ivy, Ivy at the Galleria Property Management managing the Majestic? And the answer is yes. So Tarantino happens to also manage the Majestic, which I really, really liked. So we will be using the same property manager for both properties, and we'll be saving payroll both at the Ivy at the Galleria, and then, as I showed, drastically saving over at the Majestic. Question came in, is the management on site? So the answer is no. We'll be managing from Ivy at the Galleria 1.1 miles away. But there is a lady that lives on the property that sort of is the eyes and ears of the property. I did not know that before due diligence day, and didn't really know who she was when she started showing me units. But I got to know her really well. She does live at the property. She loves the property. And she has like $125 rent discount, which I thought was, pretty cool, very reasonable for her to be eyes and ears of the property. And also she takes care of the grounds. She does some trash pickup and, she does a lot. So Tarantino asked me if we were going to continue using her. And I said, yes, I'd love to have the eyes and ears. I think it's important. So laundry facilities, there is a laundry facility on site. So I believe there were 3 washers and 2 dryers on site. One thing I liked about that, and I didn't really dive into it on my slides, but those washer and dryers are actually owned by the property. So we'll take them over, but every quarter, 75 cents, et cetera, that goes into that goes directly into our cash flow, which is different. A lot of properties, they outsource, they have another company own those, and then you get a percentage of the profit. So in this case, I'll have 100% of the profit. Now we have to maintain it and take care of it, make sure it works, which I'm not aware of any issues on that. So that was a great question. Cap rate on this was a 6% cap rate, but I did show the sensitivity analysis showing, what a 6.5 cap rate, or what a 5.5 cap rate would be. That's a really great question. Thank you for asking. So what prompts an owner to lose $1 million per current appraised value, and to that a property that may be old, but with fairly fresh physical condition? So it's a REIT. This is a large REIT out of New York. And so when they have funds and they have to close the fund, they have to sell the property. I saw this a lot in commercial real estate when I had clients that their office building was in a fund and they had to sell to close the fund. So that's what they did. But they're being pretty strategic. I see what they're doing. I like what they're doing. One, they're benefiting from getting it off their balance sheet, so they can close the fund. But 2, they're still making money in the 5 years, and they're doing that through the interest payments that we are going to be paying. So it's like $159,000 a year. So that $159,000 a year, goes to them, even though they've sold it's off the books. That's why they're doing it. It's the asset isn't being sold because they're distressed. It's not being sold because there's things that are, that nobody else wants. They wanted a clean transition from this and then go from there. So I don't know why they didn't take it to market, but I know that they didn't. And the broker I'm good friends with, he kept bringing it to, I kept saying no, because it's just smaller property. It's older, it's something I normally would do, until he's like, no, you really need to look at it. This is what they're willing to do. I was like, okay, happy to do it. Thoughts on effective recession on rent growth, exit cap rates. So on my rent growth, I just did 2% year one. Again, year one was like 5,000 from what they're already making on the T3. So felt pretty good on that. On my expenses side, if we kept rents the way they are, right, we may miss, if we just didn't do anything on the rent growth, we'll be very close to where my year one number already is. But on the expense side, I mean, you saw the drastic reduction in expenses, and it's not like, I'm not like, penciling those in trying to make it look as good. Like taxes is what it is, insurance is what it is, payroll is what it is. Like, so yeah, so I'm not too concerned on the recession piece on the rent growth. Exit cap, I mean, that is a risk, right? I mean, I'm doing 6% because I think interest rates long-term are going to be in the 5s. And then, if interest rates are in the 5s, then, exit rate cap could be 6. But that's why I like to show that analysis tab of like, all the different exit cap rates. So if we're at 6.5, we're still looking at, a 1.7 equity multiple, and a 14% average annual returns. So I still feel pretty good on the exit cap rates. Location, in my mind, really matters, and it, as all of us that are real estate investors, it matters. Being in the Galleria submarket, right off 610, in a great location, is going to strengthen the cap rates, right? We're not at Greens Point. We're not like an East Houston. I mean, there are pockets I would never buy near Hobby Airport. There's areas in Houston I just wouldn't buy, but the Galleria, the Galleria area I'm very bullish on, just because the amount of jobs and the high-end restaurants, et cetera, that are around, that all needs workers, and those workers need a place to live. So feel pretty good there. Question, the property is sold at a much lower price than appraised value and lower than the 2018 purchase price. Considering the real estate boom in the last few years, what are the reasons for this? I don't know. I think they're just trying to get off their books. I mean, I think if they went to market, they could. I mean, initially they came to me and they wanted, I want to say it was like 4.1 million. And then we got to like 3.7. And then I was like, well, insurance prices are crazy, And then they're like, okay, well, what will you do? I was like, I'll buy for 3.3. And then it went up a little bit, not much. But I mean, it was some negotiations. And insurance, I don't see any questions on that. Like, that is the risk. Like, where does insurance rates go? I mean, we secured an incredible rate at that price. And so if insurance rates go up for this property, that's where buying at the right price. That's why I didn't accept the 3.7 when they came back to me. I wanted to buy at a 400,000 less than that because of insurance rates potential. So hopefully that answers the question. Look, anybody that bought real estate last year anywhere in the country has lost value this year. It's just the cycle of real estate. Now, a lot of people will be really concerned with that, but for those investors that are worried about it, I wouldn't be. It's the cycle of real estate, and nobody, at least on my stack at CREI Partners, we're not sellers at any of our properties right now. All of ours have a rate cap. They've got fixed debt. There's time. We always buff in time to sell and such. So, but you are absolutely right. Like, there are, this market is a little more soft, which could be a reason of the appraised value and purchase price. The values of today are going to be less than they were last year. And HCAD, Harris County, is going to have to take a hit on all that, which is going to be a loss of revenue, et cetera. It's going to be in the news. A lot of people are holding off. They're staying on the sideline. They're waiting to see what happens. And I think that could be a good strategy for you. For me, it's not. Like, for me personally, I'm wanting to invest when people are not wanting to invest. And if I can get in, because there's not a lot of people jumping in and buying these type of assets and buying it below 2018 values, I'm bullish on that. Right. And so we'll see, obviously we'll see what happens. What's the projected year one bonus depreciation? We'll see about 70% value, but we've reached out to Madison Specs. We'll get more on that, but we'll see tremendous value on that. Now, tax depreciation for this year, I believe, is 80%. Last year was 100% bonus depreciation. This year's 80%. So you'll be able to use the full bonus depreciation up to 80% for your 2023 taxes. Well, it's a really great question. This next one, the gate of the property looks gorgeous. And thank you for saying it was a great presentation. I had some typos I noticed, and I went through it multiple times, but anyway, this is what it is. In which year was the motel converted to the current apartment building? That's a really good question. I don't know, but it felt like the Melrose place when I walked into that, like the courtyard, and they mentioned it was a motel at some point, which makes sense because there's not a lot of apartments in that. There's, I mentioned that it's like a half mile away, but I don't know, but it is a good question. Are there hookup in the units for laundry? It's a great question. The answer is no. At the Ivy at the Galleria, we found I'm going blank on it, but it's like a washer and dryer in one. So a lot of our residents there, or prospects there, were like, oh, they wanted a washer and dryer in the unit. And it makes sense. But it's like, okay, how do we get it there? And, what is the cost? So Tarantino helped me find a washer and dryer. It's like an all-in-one package. It's about $2,500 to install, including the unit. And what we're doing there, it's $100 rent. It's $100 rent bump or fee for that washer and dryer. So now we're not saying no, we can't there's no laundry in the units. Now we're saying yes, we can get it in two units, two different floor plans, but it's this cost and this is where it's going to be. So I know that's another property, but on this property, the answer is we can do the same. It just is going to take a portion of their living room. And so it's up to them. And I think if people know that they can do it, that reason of not leasing goes away a little bit. But no, there's a laundry room right there. It's 44 units. And for this demographic and area, it's very common to have the laundry facility. It definitely needs to be freshened up. So we'll put some paint, just make it a little bit more fresh. We'll put some revenue generating items like, laundry detergent, on the wall, et cetera, where they can purchase those. Are the estimated yearly returns similar to the Ivy property? Not at all. So that is a great question. It's two different types of investments. I always say there's always risk in all of investments, right? And that Ivy at the Galleria was a true deep value add. I mean, it was a dump. And the more we owned it, like the first few months, I was like, second, third, fourth, fifth chance people living here. Like it has taken a lot of, I'm so proud of that reposition. It took 6 months for us to do a full physical renovation of the property. And it really took till about last month, maybe the month before, to get all the bad, I say apples, quote unquote, out. It was a lot of work. We went down to 71% occupancy. We're up to 92% right now. So, we're turning the corner. That is an equity play. That was like, hey, we're buying it. And it was also sort of getting towards the peak of the market, which we knew. It required a lot of renovations. We did a full roof renovation. We did a full HVAC replacement. Everything was painted. Pool had to be drained and resurfaced, et cetera. So that is more, in my mind, an equity play. So this one, we're not having to do the true deep value add. And so that deal on Ivy, for example, like we knew we were going to lose money year one. So we put a lot of reserves because we knew it was just going to be a deep value add. This property will have that 200,000 in reserves, which is still really healthy, but we're not going in and trying to gut everything, right? And we're not trying to replace our current residents that are already paying on time, et cetera. So those returns are going to be different. This is more of a cash flow deal, where that one was more of an equity play. It is a tear down in comparison to the other comps shown. That's why I don't think we're going to get to $1.60 or $1.55. But if we can get to $1.35, $1.40, we're doing really well. And we can do that with fresh paint, having that gazebo grill area, more seating, that bike rack, refreshing the interior units. It definitely can be done. I will say this, and I say this to my team at the Ivy, where if you want to be in the Galleria area, where do you go? And so, because you saw the rates, they are where they are. So, I would say right now, I don't know who the anonymous attendee is, but if you saw photos of what the Ivy looked at last year and what those photos look like this year, you would be like, damn, that is massive transformation. And I'd love to show anybody who wants to tour that property, investor or not, because you're going to see something similar to this. When you look at the photos of this, it's an ugly duckling. There's black, tar stuff coming down from the roof. It just needs an uplift, but we'll do a fresh paint in the front. We'll pressure wash. We'll get that gazebo. We'll do the amenities. We'll do what's needed to give it new life. Even the planter boxes on the front, it's low cost, but imagine driving down Shoemaker and seeing this freshly painted accent front with greenery. It will make people look twice. And, in real estate, it's curb appeal, whether it's your single family home or your, 44 unit. So despite it being a tier down, it'll go up. The one thing we can't change is the amenities. Like, we're not putting a pool in, right? We're not doing those things. But there are a lot of people that don't care about pools and they don't want a pool. And they're not looking for a fitness center. So what they do care about is the rate of rents and, proximity to where they work. So as an asset manager, I take that into account and make sure like, hey, we're pricing right, taking care of our expenses and trying to boost NOI as much as possible so I can distribute cash flow. So given the insurance premium projections, there's a good chance we'll end up selling this at a lower price than the purchase price. How is this possibility factored into the calculations? I don't know that it will be. I mean, we can probably look to sell it as so one of the things I've looked at is selling this as a package with the Ivy as well, in 3 to 5 years, depending on what's going on with the cap markets. But the insurance premium wasn't like win Courreges deal. Like that insurance premium is what this particular well-known large carrier is doing. I also think, and I've been very close with the insurance markets and and brokers, and there's a lot of doomsday about it. And part of it is capacity, but part of it is just there's not enough carriers that have come in. A lot of them have backed out. But there's a lot of money to be made in insurance, and there are going to be carriers that enter this market. And I wouldn't be surprised if groups like Amazon and others, I mean, it sounds crazy, but money and the growth, the ability to make their investors incredible returns are there as well in the insurance markets. So, we'll see. At the end of the day, the price is based on our NOI. That's what we're going to sell it for, and just like myself, I had to find ways to make the numbers work. And the only way the numbers work is I own a property nearby that we can efficiently manage this asset. You're going to have people that need a 1031 exchange into an asset. And we see it all the time where people, they have to 1031 in a certain time frame. And so they do buy the property at a higher rate than, maybe what the market is, but they save on the taxes. So, I think right now us buying in below 2018, remember, this is a $75,000 purchase price per unit. Last year, again, it was north of 100,000, for this exact same asset class. There are people on this call that I noticed that, have invested in deals that are like 160, 170,000 plus a door in the same Galleria submarket. So, again, I'm like you, asking questions, but always trying to convince myself like, hey, is this given a good sense? Just the price per door of it alone with what we're doing and what we're planning on, I feel good about it. But obviously everybody's got to feel comfortable on the investment and feel like, all the boxes check. For myself and my investment criteria, it checked, which is why, I'm on this call with the team here. And with that, I don't think I have any more questions. We went a lot longer than I had initially planned. So I'm very grateful that y'all stood on. There's a lot of people that are still on this call with me. So thanks for hanging in there. I want to make sure I don't have any other questions. All right. So based on so many people still on this call after almost 2 hours, go ahead and please do the QR code or go to this website, reserve, first come, first serve. It's only $1.5 million raise. And again, it's for accredited and both non-accredited investors. So appreciate y'all's time. I'm going to be available tomorrow. I do this full time now. I don't know if y'all know that, but like I had a W-2 since I joined the company in 2019. We went all in on this. We've got enough investments and enough that I need to really had to leave the day job and really focus in on this, which I was already doing, but just now have a lot more time to do that plus family. So, please reach out. My email is wayne@CREIPartners.com. And I say all that because like, it's really important to have those one-on-one conversations because We want to make sure it's a good fit for you, whether it's on this deal or a future deal. I just wanted to provide this opportunity as a way to, get you invested in what I view as a solid deal in Galleria submarket. So hope everyone has a great evening. And if you need anything, please reach out. Again, Wayne at CREIPartners.com or go to CREIPartners.invportal.com. You can register, log in. You'll see other deal offerings, but the Majestic is the one for this, or you can use that QR code in the slide. So thanks, everybody. Y'all have a great day.